Good morning, everyone. My name is Andrew Tobin. I'm a partner at Mills & Reeve in the insurance sector. I'm delighted to be joined today by Simon Low, who's a director and head of political risks, credit and crisis management at Crawford & Company. Simon has more than 30 years of experience underwriting credit and political risk and political violence policies in the Lloyd's market, holding various senior positions with leading syndicates. In conversation with Simon in the next 20 minutes or so, we aim to provide a high-level overview of credit and political risk insurance and to touch upon some of the issues arising following Russia's invasion of Ukraine. If you have questions as we go along, please put them in the question and answer box where they will be collated for us to answer at the end. I should add today that our focus is on credit and political risk insurance. But if you're interested in political violence insurance, please go to our Cover Talk archive on Mills & Reeve's website, where you will find 2 detailed webinars on political violence insurance. So to kick off, Simon, and on the basis that our audience is mixed and that some will be new to these areas of work, can you explain in general terms what these political and credit risk markets are about?
Good morning. Yes, of course. The main insurers in this line of business are a mixture of multinational and large domestic companies based in the major insurance hubs. London continues to be the main base, with the other main insurance hubs populated by these companies and their subsidiaries. We're also starting to see some small specialist companies starting up in these business lines. Collectively, the market therefore has a strong international view and understanding of global trade and international supply chains, and that's critical to the underwriting of these products. The markets continue to grow and develop through the market cycles of insurance, and we now have over 60 companies providing structured trade credit and political risk insurance, with an estimated insured exposure of over $500 billion worldwide.
So what are the main characteristics of these markets?
Well, credit and political risk are 2 business areas which are often underwritten within one individual department. The credit market has 2 main lines within it and has been around in one form or another since the late 1800s. Credit insurance provides coverage for non-payment, but this can be expanded to cover the non-performance of other contractual obligations, such as non-delivery of goods or even for contract frustration by force majeure perils, such as war. The first line of business is the whole turnover credit market, which mostly covers short-term multi-buyer policies for sellers of goods and services. This is generally focused on domestic markets without a cross-border interest in the transaction. Most developed countries provide their own agency. For example, government-owned companies such as the UK Export Finance, Sinosure in China, and Euler Hermes in Germany. There are some major private entities as well, for example, Chubb and Atradius, as well as small specialist companies such as Nexus Sifs, also provide insurance in this market. Secondly, there is a line of business called structured trade credit, which is provided by the specialist private markets. Again, it provides cover for non-payment and include associated perils such as confiscation of the asset and non-honouring of arbitration awards, as well as contract frustration through force majeure perils. These products are written on risk around the world by London and other international insurance hubs. This product can be adapted easily to cover many types of contractual obligation. Specific financial instruments can also be covered, such as non-honouring of guarantees or unfair calling of on-demand bonds.
And do these government-owned companies you mentioned work with the private markets?
Yes, we often see the public and private markets work together. This enables them to provide more capacity, especially when required for high-risk countries or obligors. The private market often provides more bespoke cover, especially when provided for a specific trade transaction, loan, investment, or project which is described as structured trade credit insurance.
You mentioned at the start of our discussion that this business area is split into 2 main parts, being credit and political risks. What characteristics does political risk insurance have?
Yes, the political risk market only really started in the late 1970s as a standalone market providing a defined peril insurance. This coverage is purchased by investors, lenders, and it protects their financial interest, being either a shareholding or lender's interest in a fixed tangible asset, project, or even mobile assets within a foreign country. The main perils insured are confiscation, nationalisation, expropriation, and deprivation, which all provide cover against the insured losing control of their interest either physically or financially. Other associated perils insured within this insurance policy can be manuscripted into a package policy to fit the requirements of the insured and the nature of the risk. These commonly include property damage and business interruption cover from political violence perils, such as war, terrorism, strikes, riots, and civil commotion.
And I understand that other additional perils can also be included into these packages.
Yes, often extensions are included to provide a bespoke cover. These normally include perils such as selective discrimination, forced divestiture, and forced abandonment. These are all named perils subject to a specific definition in the policy. Forced abandonment can protect the insured property within an active war zone, where it's no longer safe for the insured to provide personnel to manage and secure their insured property or the assets within. This could be relevant in Ukraine, where the invasion by Russia has meant that several cities and the industrial units within have had to be abandoned after fierce fighting. Other additional coverages are also available within the political risk package. These additional defined perils are available on a bespoke basis, depending on the underlying risk. These include license cancellation, forced abandonment, selective discrimination, forced divestiture, currency convertibility, exchange transfer, and non-honouring of arbitration awards. For example, a mine operation in Africa, they would need an export license to transship the commodity overseas to allow it to access the international markets for hard currency sales and to maximise their returns. These export licenses would be required to be valid for the policy period, so they can be insured against illegal cancellation or even non-renewal, if the contractual terms provide for this. A pre-approved dispute resolution clause in the contract would often name an arbitration body to hear and assess any dispute. Non-honouring insurance will protect the insured if its counterparty does not honour that arbitration award.
And can you explain to us what is meant by structured trade credit?
Yes, we have a slide on this. This shows the flow of business and where the insurance policy sits behind the insured. Structured trade credit provides that non-payment and non-performance insurance for a specific contract that has been negotiated for a trade, loan, or investment. This market is very much focused on the developing countries, being the emerging markets, where there's generally a higher political peril and uncertain trading environments, which can provide additional obstacles for cross-border trades.
And how do these risks reach the insurance market?
So this is the transaction will be analysed, often with a specialist professional insurance broker and the insured's risk manager, to assess the perils they are facing. The main standard peril of non-payment and non-delivery may be enhanced to add further specific coverages, such as contract frustration through war, embargo, or natural catastrophes. Also, the non-honouring of specific financial instruments, as well as non-honouring of an arbitration award if a dispute arises and cannot be resolved through normal negotiations. The policy wording is often bespoke and manuscripted around the individual trade transaction, as well as the industry and country-specific characteristics. Once the coverage has been agreed, the information will be collated and presented to a number of underwriters for quoting. They would have been selected due to being a specialist in this type of risk and for having market capacity available for both the obligor and the country. As well as a price, the broker will request a proposed line size as a proportion of the limit being sought. The broker can then determine if a syndicated placement is required to achieve the policy limit. Several options would be offered to the insured for them to decide which market they wish to offer a firm order to. The broker will then finalise the placement and conclude the contract for the required policy period. The normal buyers of this type of insurance are often financial institutions and traders, and they are looking primarily to insure themselves against the credit risk, but also government or political interference that can frustrate a contract, force majeure perils resulting in a non-payment. A good example of this is where a prepayment is made as a deposit to a mine or to secure future deliveries. If the financial security of the supplier is deemed inadequate, an advance payment bond or a standby letter of credit can be negotiated to act as security against this deposit, in case the ordered deliveries are disrupted or not honoured. If the following dispute cannot be resolved as per the agreed contractual terms, then the above security can be called, and if not honoured, the non-payment can be collected against the trade credit insurance policy.
And what can you tell us about the terms and conditions of these policies?
Well, credit insurance will cover the non-payment for any reason, as long as it's a valid payment under the insured contract and within the terms and conditions of both the insured trade contract as well as the insurance policy. As these are often manuscripted policies which are bespoke creations to ensure a specific risk transaction, conditions and exclusions can be limited. Typically, policy language will describe the risk and define the perils insured and will contain a requirement about disclosure by the insured of all the material facts pertaining to the insurable risk. Exclusions are limited compared to other insurance markets, but some are mandatory and prescribed by regulators. This is to control aggregate exposures and protect the financial strength of the insurance industry for that policyholder. For example, the 5 great powers war exclusion and the nuclear, chemical, biological exclusion, though even these perils can be covered with express prior permission from Lloyd's on a one-off basis.
And may I add here that there are some particular terms and conditions that one often sees in credit and political risk policies. I just wanted to mention 3 today. Firstly, there's nearly always a term by which the insured promises to retain part of the risk itself and not to insure it elsewhere. The insured is always closer to the events on the ground, and insurers want to ensure that the insured has an interest in avoiding claims and mitigating risk. So the policy will usually stipulate that the insured retain 10% at least or more of the exposure for its own account. Secondly, credit and political risk policies invariably have what is known as a waiting period. This is a minimum time period stipulated in the policy that must elapse after the occurrence of an insured peril, such as a contractual default or a taking, and before any liability will accrue under the policy. A typical period is 180 days, but it can be longer or shorter. The insurer hopes that in that period, the insured will work with its counterparty to remedy the default and thus avoid making a claim under the policy. Thirdly, credit policies nearly always have a clause warranting that the insured obligation or contract does indeed create a legally enforceable indebtedness or obligation under whatever law governs it. This is important because insurers only want to insure the default of specifically defined legal obligations. And secondly, because if they do have to pay a claim, they'll want to rely on enforcing that obligation against the debtor by way of subrogation. So they need to know that it is a sound and enforceable obligation. There are other terms and conditions I could have mentioned, but I don't want to use up too much of Simon's time. Simon, given the invasion of Ukraine by Russia, what claims are expected to arise in the political risk and credit markets?
Well, probably the Ukraine crisis in its broadest sense has the potential to be one of the more catastrophic events facing the insurance market in its recent history. The main markets expected to be impacted are the aviation, war and terrorism, political risk, credit, as well as the marine hull and cargo. The immediate impact is to property and cargoes on the ground in the conflict zones, with ripples spreading through the region and worldwide, affecting the supply chains directly and indirectly, as sanctions prevent raw materials and financing reaching international trade and manufacturing processes. Russia has been developing very fast over the last 30 years as a major trade partner, particularly with the soft commodities and the oil and gas industries. This has meant a large increase in exposures for the political risk and credit market as financiers, traders, and industrialists look to protect their investments, trade receivables, loans, all of these from non-payment and government action. These are now at high risk of suffering losses from non-payment as well as at government action against those property and investments, either through expropriation, forced divestiture, and selective discrimination. These insured perils need a more detailed explanation than maybe we can do another day.
And are you seeing any claims come through at the moment? And if so, how are you approaching them?
So the most prevalent claims we're seeing currently are the property damage losses from the invasion into Ukraine. We're fortunate enough as a company to have an office on the ground. So we can conduct a site survey and when safe enough to do so. Other options are also available. For example, we have access to satellite imagery or drones where appropriate. We also use forensic accountants to conduct analysis when considering the business interruption losses. Where credit risks are exposed, we are seeing delays and some defaults, which have triggered the waiting period within the insurance policy. This is normally 180 days, but it can be longer. Though some extensions and renegotiated terms to the original contract have already been agreed. This is primarily where the force majeure nature of the event has caused the Ukrainian counterparties to be unable to fulfill their obligations, but also where political intervention through sanctions and embargoes have meant normal trade has been interrupted. Currently, we have not seen any expropriation or political risk perils being claimed upon, though these remain at high risk and foreign government action remains a real risk for these exposures. As loss adjusters, we wait for a claims instruction to be notified before we can start investigating and conducting our fact-finding work, though we are seeing more and more occasions where we are instructed prior to a loss notification, where we can use our contacts and experience to instigate risk mitigation action to minimize any loss for the insured and the underwriters. This is especially true in cases where the insured's private security provider cannot be expected to remain in situ during a general war situation. As part of this risk mitigation, loss adjusters provide a service either directly or through contractors to remove mobile assets by available infrastructure or secure any asset or property to mitigate any future loss. The limited action is available where, for example, the main risk is confiscation by de facto government, though advanced work can be conducted to identify offshore assets to pursue a recovery action at an appropriate later date. It is important insureds continue to monitor their businesses and communicate with their insurers whilst taking these steps to mitigate or reduce any risk whilst acting as if uninsured.
Well, thank you very much, Simon, for that whistle-stop tour. I appreciate that you touched on a lot of areas and that many of our listeners may like more detail. If so, may I suggest that everyone feels free to contact Simon Low or myself directly after this event. Copies of the slides will be going out with our respective contact details. So I think we're just about on time. Harriet, do we have any questions?
We do indeed, and if I may ask the question of you first, Simon, what impact will financial sanctions have on these products and claims?
Well, we haven't seen a direct claim yet from the application of a sanction, though by their nature, sanctions are designed to have an effect as wide as possible. So we would expect there to be a knock-on effect to the global supply chain eventually. Credit insurance can pay a loss where the proximate cause of loss was a sanction, which has caused the default of an insured payment. So sanctions themselves will cause defaults in contracts and therefore claims. And given the widespread nature of sanctions, a myriad of claims is likely.
Do you have an example you can give?
Yes, I mean, as an example, we could see a beneficiary bank in the UK having a currency inconvertibility or an exchange transfer problem, where there is a non-transfer of funds from Russia, for example, into a contractually agreed hard currency. This would be from the obligor's local bank based in Russia, and this can be from a supply of good or service into Russia, where the current sanctions have impacted the ability of the Russian buyer to pay in that required contractual term or within the agreed credit period.
Do you have a view on this, Andrew?
Well, as Simon said, losses caused by sanctions are not excluded from credit and political risk policies. And in fact, that's one of the reasons why people might want to buy them. But confusingly, however, all the policies will contain sanctions exclusions in them. But what that does is to prevent the payment if a claim is covered, the sanctions exclusion clause will prevent payment by the insurer to the insured if to do so would break sanctions. For example, because the insured itself is sanctioned. And obviously insurers have got compliance teams to check that any payments they make are compliant. Sanctions are also going to be relevant when it comes to recoveries. Sorry, just going back a step. If a claim payment is sanctioned, the advice might be to insurers to hold the claim payment on escrow until such time as they get a license to make the claim payment or until the sanctions are lifted. And sanctions are also going to be relevant to recoveries. They're going to greatly complicate recoveries if the target for a subrogated recovery is itself subject to sanctions because it's Russian or sanctioned for some other reason.
You briefly touched upon subrogation there. I mean, are there actions available to the market?
Well, subrogation is important to the economics of the credit and political risk market. It's important that in general terms, the market does make good recoveries. Insurers, credit and political risk insurers, like all insurers, have common law subrogation rights, but the common law does have, leaves a number of questions unanswered. So often policies will try to clarify how recoveries are to be distributed, who is to control claims, and so on. But often even the wordings leave things unclear. So if things are clear, then there can be an opportunity when a claim is paid or compromised to try and clarify clarify with the insured how to organise a recovery action.
Thank you for that. In keeping with our usual attempt to finish within time, I'm going to stop the questions there. There are a couple more, but I know you'll deal with them outside of this later on. So the baton back to you, Andrew.
Well, thank you very much for joining us. Please do contact Simon or I directly with any questions you may have. Our next cover talk will be on the 22nd of September, when David Gooding and Alexa Jones will discuss dishonesty investigations in the context of professional indemnity insurance. Thank you all very much for your attention this morning.